inflation out of China rising 2.1% year over year, just as China reopens. William Li of the Milken Institute says this about China. China's post-COVID recovery is the heart of upside risk to consensus forecasts on both global inflation and growth. However, and this is the important line, Tom, China's recovery may not spur a global growth rebound by as much as its past expansions.
It is Friday, and what we're doing is framing, and I get it on finance and economics, John. We're framing out the inflation report on Wednesday. But this is a really, really important conversation to get you ready for your thinking on the weekend of where we're going in 2023. William Li is chief economist at the Milken Institute with public service to the International Monetary Fund, a tour of duty at Citigroup as well. And we're thrilled that Bill Li could join us this morning. Bill, your opinion is courageous, narrow, and controversial. You think Wall Street is nuts about the China group think that they're going to come back and we're going to boom. Do you doubt China GDP of 5 or dare I say 6%?
A lot of the Wall Street consensus is looking toward high numbers of China growth rates, and even as high as 6 and 7% with the economic rebound we're about to have. But people are overestimating how hard it is to get the supply side back online, and the fact that the policy in China now is to emphasize domestic demand, domestic consumption. So if people are expecting the export engine of China to be reviving again and pushing up commodity prices, I think that's the wrong place to look. Look to the tourists from China going out. And Tom, we talked about the two Americas. Well, right now in China, there are 3 Chinas. The very rich will be the big tourists, the rising middle class that'll be engaging in some of that behavior. But the bulk of the population is worried about their wealth being caught up in the collapse of the property market, and the fact that their household income is in the doldrums because their youth unemployment rate is so high, their kids are not getting jobs.
I want to do the Bill Li breakdown here, Bill. As you know, when I go to China, I go deep into China, which is 150 feet past the Mandarin in Hong Kong. I want to go into the way you think about the domestic politics, in that the Wall Street groupthink on China is wrapped around Shanghai and Hong Kong and Beijing, and you have the courage to go across the country. What is the distinction of Central and Western China?
I think one of the things that people have missed is the emphasis by Xi Jinping of wanting to spread growth throughout the country. And the Milken Institute's own study of the best performing cities in China has pointed to Chengdu as being an innovation center out west, a budding innovation center. And Chongqing has become a regional growth center that was supposed to be at the heart of the Belt and Road strategy. Well, the strategy to try to push growth out west is still there, but Western investors are ignoring that. And I think one of the things that we have to keep in mind is that China is more than the Mandarin hotels in Shenzhen, Hong Kong, and Beijing.
You tell him, Bill. You tell him.
Service announcement.
Bill's been telling me for years.
That was aimed at you.
Bill's been telling me that for years. That's not news.
Hey, Bill, let's put some numbers on what consensus is. You know the function on the Bloomberg ECFC. Type in a country. I've put in China. This is the consensus forecast for 23, 5.1%, a snapback from 3 last year. Looking out to 24, the message seems to be get comfortable with 5% again in 2024. Can you put some numbers on your own forecast here, Bill, as you push back against that consensus 5%?
Well, I think the audience would say, well, who cares about Bill Li's forecast? So let me go to my old authorities, the IMF. The IMF is very close to consensus almost all the time. But the fact that the IMF is looking to 2 handles and 3 handles out 5 years for China's growth tells you something about the reality of China. The IMF almost never deviates from consensus unless there's a darn good reason to. And I think that's a good evidence to say that we are not going to have the kind of high growth rates we had before, because China's productivity and labor growth rates just aren't there to support the 5, 6, and 7% growth rates we've seen in the past.
Well, there are 2 different points here, Bill, and I'd love you to parse through them. There's the headline number that might be juiced by stimulus by the Chinese government, which we're seeing happen, as well as different types of regulatory policies. And then there is the stimulative effect on the rest of the global economy. Could it be possible for China to get headline numbers that they publish of 5% while also not having a stimulative effect on other economies because of the domestic focus of all of these programs?
Bingo, Lisa. I can almost guarantee you that the next set of numbers coming out of China's GDP will have very spectacular numbers on it, high fives, sixes, possibly even sevens, because the rebound effect is going to be amplified by the way the numbers are being cooked by forecasters. But I think the reality is that China's policy is one of emphasizing domestic demand, emphasizing investment toward building domestic champions, companies that will be helping China's domestic economy. And so the focus on domestic consumption, especially in services, means that we're not going to see spikes in commodity prices. We're going to be seeing spikes in airline tickets and travel destinations and hotels. And that service sector constraint is something that's still very severe in China because it hasn't been built up as much as it has been in the West. So I think going forward, we should see inflation numbers rise, but in different areas. Even the current numbers that we're citing now, 2% inflation that just got released, most of that was food. If you look at the core inflation numbers, it's about 1%. So where is the spike that we're supposed to be seeing from the rebound? Not near that.
Well, so this is actually positive in terms of the potential ramifications for Europe in particular when it comes to crude prices as China reopens, but it has a pretty negative implication with respect to some of the growth that's being priced in to Germany in particular on the heels of China's reopening. How misplaced are some of those hopes?
I think a lot of them are very misplaced because, again, the policy of China that Xi Jinping announced after the Party Congress is we want to build domestic demand. We want to build domestic consumption. That's not the kind of stuff that makes for a lot of imports of BMWs, except for the dual China or the tri-China's notion that Tom and I have often talked about, that the very rich will always be importing luxury goods, and BMWs and Mercedes will be part of that story. But the bulk of the Chinese population is still struggling, and struggling even more so post-COVID and post the property market collapse. Unless the reforms are put in place to restore the confidence that Chinese people have in the property market as a store of wealth, we're not going to see the consumption burst sustained that we saw in the past. And I think that's something that the Western forecasters have not put in place yet.